Anomalies are strategies based on usually quite simple, publicly observable variables that don't seem to be related to risk, but do predict stock returns. A simple example would be something called stock return momentum. So it turns out that stocks that had high past returns over the last 6 months also tend to have high stock returns over the next 6 months. And also stocks that had low past returns tend to continue to have low returns. What our paper does is we try to shed a little more light on this. And what we show is that for almost 100 different anomalies, the returns that you earn, the abnormal returns, you only earn them on certain days. And those are days when firms either announce earnings or days when firms are covered in a Dow Jones news story. What we think is going on is that investors have biased expectations. These anomaly variables are correlated with those expectations. When there's a news story or an earnings announcement, investors realize what they're expecting of the company is probably not going to be true. They then update their beliefs, and that's what causes the stock price reaction. A very simple, intuitive example that we like is a sales growth anomaly. So that anomaly, stocks that had high sales growth over the last 5 years tend to have low stock returns. And one reason that could be is that investors so a company had very high sales growth over the last 5 years. Investors kind of naively extrapolate that into the future. And when the firm announces its earnings, it turns out it's not growing as fast as it was in the past. Investors are disappointed. They kind of downward revise their expectations of how fast a company is going to grow, and that's why you see the stock price drop so much on that day. The reason this is an anomaly is that you can predict this ahead of time. You can form portfolios of firms with high sales growth before they announce their earnings and predict that this is going to happen. Our key takeaway is that probably the most likely explanation for these anomaly stock returns is mispricing. So what causes the mispricing is that investors have biased expectations. They think they're too optimistic about some stocks, too pessimistic about other stocks. Other explanations people have put forward are risk or data mining or things like that, but we think our results are most consistent with markets being inefficient and stocks being mispriced.